This is certainly an unusual year for the college admissions process, and not one that anyone would have chosen. It's going to be particularly difficult for juniors this year, because typically in the spring or the summer is when you'd be visiting colleges and finding out about what they have to offer and what colleges the student prefers. This is going to be something this year that really you're going to have to rely on online resources for that. The financial aid elements of the college process, I think, will be pretty consistent with what we've seen in the past. So I think that the material we're going to discuss tonight will be very relevant to you as you go through the college search, at least in terms of thinking about the financial aid portion. So hopefully this will be helpful for you as you do go through that. So we're going to talk about two big topics tonight. One of them is assessing where you might get aid. And really, when colleges are deciding that, they're looking at it from the student's perspective. But because of the way our paying for college system works, of course, it's really the parents who are responsible in large part for the expenses of college. So it's going to be both the students and the parents that we talk about throughout. We'll also talk about deciding what you can afford. Now, assessing where you might get aid is really a question of identifying the student's profile in terms of potential eligibility for need-based aid and merit-based academic scholarships, and then matching the student's profile with the way colleges award aid. So colleges don't award aid in the same way. Some of them are more oriented to awarding need-based aid. Some of them award more merit-based aid. So depending on your student's profile, where the student might receive aid depends a lot on which particular colleges the student is applying to. So we'll talk about that in a lot of detail tonight. Deciding what you can afford is a question of thinking about what is the true cost of college. That's not always obvious, and so we'll talk about that. It also means thinking about the resources that you have available to pay for college. If there's going to be debt involved, it's thinking about whether you're going to need to borrow for college. And if you borrow, you want to make sure you understand that the amount that you're borrowing is reasonable. So my name is Bill Smith. I've worked with Freeport High School for a few years doing these types of presentations, and really enjoy it. I much prefer being there in person, but it's good that we're able to take advantage of technology to be together tonight. I got into the college world because I used to sell financial aid software to colleges, and as colleges were thinking about how they wanted us to program their software, they would describe how they awarded the aid, and then we'd program that in. So about 6 years ago, I began working directly with families to think about how they can find affordable colleges, and it's been a very rewarding path for me. So hopefully it will be helpful for you tonight. So, as I said, the net price is really one of the most important things that you want to be sure that you focus on as you think about the cost of college. And when most people think about the cost of college, they typically think about the starting price, which I call the sticker price or the cost of attendance. And that ranges from about $23,000 at USM to $54,000 at University of New England, to about 68, or actually now over 70,000 at Bowdoin. But it turns out that colleges award a pretty significant amount of financial aid, gift financial aid, that helps to lower the cost of college. So when you subtract the average amount of gift aid that's awarded to students who receive aid at given colleges, the average net price, which is the cost minus gift aid, ranges from $12,000 at USM to $33,000 at UNE to $25,000 at Bowdoin. But it turns out that not everyone receives gift aid at college. So at USM, about 87% of students do. At Orono and UNE, it's 99 and 100%. But at Bowdoin, it's only 52% of the students who receive gift aid. What that means is that at Bowdoin, 48% of the students are paying the full 70 or 68 or 70,000 to attend Bowdoin. So when you factor that question of who's actually receiving aid in, the true net price ranges from about $13,000 at USM up to almost $46,000 at Bowdoin. So the point of this is just to help you remember that what you need to do when you focus on the cost of college is not what colleges charge, but what you're actually going to pay. And what you pay is called the net price. And the net price equals the cost of attendance, that sticker price that we talked about, minus gift aid. So let's talk a little bit more about gift aid and the types of financial aid. So gift aid is free money. That's financial aid that colleges award that doesn't have to be repaid. It actually reduces the cost of college. And there are two types of gift aid. One of them is grants, which is the term that's usually used to refer to gift aid that's awarded based on financial need. And the other type is scholarships. And scholarships is the term that's usually used to refer to gift aid that is awarded based on merit. And merit really means the student's academic background. The other type of financial aid is self-help. And this is financial aid that helps you manage the cost of college, but doesn't actually reduce it. So there are two types of self-help. One of them is work study. That's a job that the student gets during college and can use to help pay for college expenses. And then the other type of self-help are loans, money that's borrowed to pay the college bill, but has to be repaid with interest after college. So when you look at those two types of financial aid, it's pretty clear that gift aid is a lot better than self-help. Seems kind of obvious. But when colleges tell you how much college is going to cost, it becomes much less obvious. The way colleges tell you how much it's going to cost or how much financial aid you're going to get is on what's called an award letter. And if you look at this award letter from this particular college, they're saying that the amount of financial aid is about $22,000 for 1 year of college. That sounds pretty good. But it turns out that out of the 7 items on this award letter, 4 of them are gift aid, 2 of them are loans, and 1 of them is work study. So you really need to make sure that you distinguish between gift aid, loans, and work study. And when I added up those subtotals, the gift aid came to about $15,000, loans were $5,500, and work study was $1,800. Well, $15,000 is still a lot of money, but it's definitely not as good as $22,000. And there's still some important information that's missing. For example, what's that starting cost or the sticker price? And after you subtract the gift aid, what's the net price, the true cost of 1 year of this college? Well, I went online and looked it up, and it turns out that the sticker price, the cost of attendance, was just under $50,000, $49,765. When you subtract the $14,900 of gift aid, the net price for 1 year at this college was $34,865. So keep that number in mind because we're going to come back to it at the end of the evening tonight and talk about that a little bit more. But first, let's get into a little bit more detail about gift aid. So we said that there are two types of gift aid. One of them is need-based aid or grants. And this is based on the family's economic circumstances. And what they're really looking at are income and assets. You apply for this type of gift aid at all U.S. colleges using the FAFSA form. The FAFSA is required for gift aid, excuse me, gift aid and loans at all U.S. colleges. At about 150 colleges, in addition to the FAFSA, they require an additional form called the CSS profile. And the profile is used at that group of 150 colleges to award college-funded gift aid. So there are actually over 2,500 four-year colleges in the US. Only about 150 use the profile, but they tend to be among the most generous and well-known colleges. So there is a good chance that if you apply for financial aid, you will be encountering the profile. The other type of gift aid is merit-based aid or scholarships. And this is typically based on things like the student's grades, test scores, class rank, recommendations, and so on. Now, this is often awarded automatically without an additional application after the student applies to the college. So in most cases, merit aid is offered by the college when they send the student the admittance letter. And what they'll do is they'll say, congratulations, you've been admitted to our college, and we're going to award you $40,000 in scholarships paid out at a rate of $10,000 per year. That's very typical. However, there are some types of merit aid that do require an additional application to the college. And so you always want to make sure that you go to the college's website and read their financial aid pages so that you know how to apply for as much gift aid as possible. So let's go into a little bit more detail about need-based aid, because this is what people traditionally have thought of when they think about financial aid. This is the algebra portion of the evening. Need equals COA minus EFC. And this is the definition of financial need in the college financial aid world. Now, need is the potential eligibility for need-based aid. It's not necessarily the amount of aid that a student is going to get. So let's break that down a little bit. COA stands for cost of attendance, and that's always made up of 4 elements: tuition and fees, room and board, books and supplies, and then transportation and other miscellaneous expenses. EFC stands for expected family contribution. And this is the most misleading term in the English language, because if you read it in English, it makes you think that's what you're going to pay for college. But in reality, very few people pay anything like their EFC for college. So all it really is a way of ranking students based on their economic circumstances compared to everyone else who's applying to college. Now, another important thing to keep in mind is that college aid policies vary. Some colleges award meet full financial need. Other colleges meet very little financial need. And it's going to be based on what the information the parents and the students submit on their FAFSA and their profile forms. So remember at the beginning, I said that finding aid is a question of understanding your student's profile and matching it to the way colleges award financial aid. If you've got a lot of financial need, then ideally you want to find colleges that award significant need-based financial aid. If you don't have a lot of need, then applying to colleges that are primarily need-based probably isn't going to help you in terms of getting financial aid. If you are interested, you can go to this website and estimate your EFC. And knowing your EFC is helpful, but it's not sufficient. So what do I mean by that? Let's say you go to that website and you estimate your EFC and it turns out to be 30,000. Well, that tells you that you're not going to be eligible for any need-based aid at the University of Maine, because their cost at 24,000 is less than the EFC. You're only eligible for aid if the EFC is less than the college's cost of attendance. On the other hand, if you look at Bowdoin, which is about 70,000, subtract 30,000 EFC, you could be eligible for as much as 40,000 in need-based aid at Bowdoin. So that's why knowing your EFC can be helpful, but not enough. And don't forget, I'm going to be happy to email these slides to everyone at the end of the presentation, so don't feel like you need to copy down any of these hyperlinks or anything. The other thing to know about financial need is that each college defines its idea of need, and it's rarely the same as the family's idea of need. So let's talk a little bit more about the EFC, because that's what really determines eligibility for need-based aid. That's really the key in understanding what the student's profile is in terms of being eligible potentially for need-based aid. So there are two formulas that are used to determine the EFC, one based on the information submitted on the FAFSA form, the other based on information submitted on the profile, but they both use the same basic approach. And that approach is to look at the income and the assets of the parents and the students. So what's going on in the background when the EFC is calculated is that there are 4 separate calculations being made in the background. They're all added together, and the sum of those 4 subtotals is going to be the EFC for that student. So one of the most important parts of the EFC is going to be the parent portion that comes from income. So a lot of people, when they talk about financial aid, say, oh my gosh, my assets are going to kill me for financial aid. That's really usually not the case. In most cases, income plays a much bigger role in determining financial need than assets do. So the way the portion from income is calculated is that they start with adjusted gross income from your tax return. They add certain items that aren't included on the tax return, and so those are called untaxed income. They subtract some minimal allowances for basic living expenses, and then they assess whatever is left at progressive rates, the maximum rate being 47%. So what that means is that once you get into the maximum bracket in this EFC calculation, every dollar of additional income is going to raise the EFC by about 47 cents. Assets, on the other hand, have a much lower assessment rate. So they add up assets. They typically include cash, investment accounts, real estate other than the primary residence, except for the profile. The profile includes the primary residence, the FAFSA does not. Again, they're going to subtract some very minimal allowances for saving for retirement and so on. And then they're going to assess whatever's left at a rate of up to 5.64%. So what that means is that once you hit that maximum rate, every dollar of additional assets adds about a nickel to the EFC. So as you can see, the income plays a much bigger role in most cases than assets do. Student income and assets are assessed similarly. The main difference is that if there happen to be assets in the student's name, they're assessed significantly more heavily than they would be if they're in the parent's name. So student assets are assessed at 20 to 25% compared to 5.64% for parent assets. Now, there is a loophole that is available to ordinary people if there happen to be assets in the name of the student. And that is to move those assets into a 529 account that's owned by the student. There's a special exception in the financial aid formulas that provides that 529 accounts are assessed at as a parent asset, even if they're owned by the student. So if, for example, grandparents maybe gave a savings account to the student long ago, that money can potentially be moved into a 529 account to have less impact on the EFC. Now, there are some special cases in determining the EFC that I want to highlight. And one of the most important ones is the case when there are multiple siblings in college at the same time. And in this case, the parent portion of the EFC is going to be shared among the siblings. So if your family planning strategy was to have your kids bang, 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 that was a good financial aid strategy as well. It's generally advantageous to have kids in school, in college simultaneously rather than sequentially. Another special case is when the family's economic circumstances change after the year that's being considered in the financial aid formulas. So the financial aid formulas are going to be looking at income that was earned in the past. And particularly this year, with all of the economic disruption caused by the coronavirus and so on, a lot of people will be required to submit information about income that was earned in the past, but perhaps they've had job disruption or something like that. In that case, you need to report the information as it is asked, so as it actually occurred in the past, but then you want to get in touch with the colleges that your student is applying to and say, hey, my circumstances have changed, and I would like you to consider this additional information when you judge my eligibility for need-based aid. Now, colleges aren't required to do that, but generally they will look at it, and often they will make adjustments if your circumstances have changed. The final special circumstance I want to talk about is cases where the parents are divorced or separated. And here, the FAFSA and the profile have very different approaches. The FAFSA is going to look at the custodial parent only, and if that parent has remarried, they will also look at the new spouse. So they might be looking at the income and assets of the custodial parent, and if that person's remarried, the new husband or wife. Now, custodial means something very different in the financial aid world than it does in a divorce agreement. So custodial in the financial aid world means the student with whom, or the parent with whom the student lived more than half the time. So even if the student is claimed as a dependent on the non-custodial parent's tax return, that's perfectly okay from a financial aid standpoint. The custodial parent for financial aid will be the parent with whom the student lived most of the time. The profile is going to take a different approach. They're going to look at the income and assets of both biological parents, regardless of whether they're in the same household or not. And if those parents have remarried, they will also look at the income and assets of the new spouses. So in the case of the profile, it's possible that they may be looking at income and assets of as many as 4 different people in determining eligibility for need-based aid. Now, they do some calculations in the background that are intended to put the primary responsibility for college on the biological parents, but those background calculations are not always perfect. So it can be a disadvantage if the parents have remarried in those cases. So what we've been talking about up till now is the student's profile, the student's eligibility for need-based aid. What I want to talk about now are, are cases of how you identify colleges that might meet financial need. So if you've determined that your student has financial need, how do you find colleges where this might award financial aid to meet that need? This is a website that's maintained by the College Board, and it's got all kinds of information, including about paying for college. So at the University of Maine, for example, they meet 68% of need on average. However, out of the 68% of need met, they meet about 51% of it on average with gift aid and 49% of it with self-help. So remember, you always would rather get gift aid than self-help. So at the University of Maine, 68% of need met times 51% of the need being met with gift aid means that on average, 35% of need is met with gift aid. Now, the University of Maine is still usually affordable for Maine residents because their starting cost is lower, but it's not necessarily because of the way they meet financial need. At the University of New England, they don't provide information about how much financial need they meet. And that's usually not a good sign if you're looking for need-based aid. And indeed, in my experience, need-based aid at the University of New England isn't that great. They do offer a significant amount of merit-based aid, but if your student has high financial need, that may not be the best match in terms of finding an affordable college. At BU, they meet about 91% of need, and of that, about 78% is met with gift aid. So on average, they meet 71% of need with gift aid. At Colby, which is kind of the gold standard of meeting financial need, they meet 100% of need and 92% of it is met with gift aid. So Colby, Bates, and Bowdoin colleges are among what I call the gold standard of colleges that meet financial need. So if you determine that your student has a lot of need, this is one resource that you can look at to see if you can identify colleges that meet that need. Now, these are averages. They give you an idea of where to look, but they don't necessarily tell you exactly what it's going to mean for you. We'll talk about that in a moment. So we said earlier that the income year that's being considered for the financial aid forms is one that occurred in the past. And this is a visual that I think makes it easier to see what's going on. So this example is for current juniors who will be graduating next year in the high school class of 2021. So for these students' first year of college, the FAFSA and the profile forms will be asking about income that was earned in calendar year 2019, so the year that ended this past December. You've probably already filed your taxes, or you will be by July 15th. By the time your student is applying to college this fall, the taxes will be done. You'll be able to file the FAFSA using that prior year information. And then early in 2021, when your student is a senior in high school, colleges will make announcements of whether the students are admitted and how much financial aid they might be awarded. Assets are valued as of the date that you file the financial aid forms. So for high school students in the class of 2021, who are going to be starting college in the fall of 2021, you're probably going to be looking at assets in the fall of this year, the fall of 2020. And so if you have some expenses that you know you have to pay. An example of this might be a self-employed person who pays estimated taxes. You might want to think about paying your estimated taxes before you file the FAFSA and the profile. Now, you might want to file your FAFSA and profile early to coincide with when the student is applying to college. So that means it might be somewhat advantageous to pay those estimated taxes a little bit earlier so that they won't appear on the financial aid forms and be assessed in determining eligibility for need-based aid. So this is a table that I won't go through in too much detail, but if you ask for the slides, I'll send it to you, and it gives you kind of what to expect if your student is a junior in the high school class of 2021. So for the student's first year of college, they'll be looking at income earned in 2019. For the second year, they'll be looking at income earned in 2020. The third year will be income in 2021, and the fourth will be 2022. You need to file the FAFSA and the profile each year in most cases in order to continue to be eligible for need-based financial aid and loans. Now, the timing of this presents a potential planning opportunity if the student is fortunate enough to have grandparents who might be wanting to help pay for college. So when we talked about determining eligibility for need-based aid, we said that they look at the income and assets of the parents and the student. So they're not looking at the grandparents' income or assets. But when the grandparents use money to help pay for college, that money is considered untaxed income to the student. Well, because of the timing, if the grandparents make their payments after January 1st of the student's sophomore year of college, the final income year being considered for the FAFSA and profile will have passed. So in other words, the final year that's being considered for FAFSA and profile is the year that ends in December of the student's sophomore year. If the grandparents make those payments after December of the sophomore year, even though it's untaxed income, it won't affect the student's eligibility for need-based aid. Now, this is only an issue if the student is receiving need-based aid. So if the student isn't receiving need-based aid, you don't need to worry about it. But if they are, this potentially could be helpful in planning. So if your students are younger, here's the table for sophomores, and then another for ninth graders. So a lot of people, because they do tend to focus on need-based aid, need to think about whether need-based aid is going to make college affordable. So I want to show you an example at a generous full-need college, how they might award financial aid. This college has a starting cost of $72,000 a year, and the EFC is $50,000. So the parents might be thinking, okay, $50,000 is what I'm going to pay for college. 50,000 times 4 is 200,000. That's what I need to budget for college. And in fact, when you do the arithmetic, 72,000 minus the EFC of 50,000 means that there's 22,000 of need. Well, this college meets 100% of need, but it meets the first portion of need with a loan. So 4,500 of that need is going to be met with loan. The next $2,200 are going to be met with a work-study award. And then only after loans and work-study are awarded will this college start to award gift aid. So in this case, after subtracting loans and work-study from the $22,000 of need, this student is going to receive $15,275 of gift aid, meaning that the net price, the cost of attendance minus the gift aid, is $56,725 for this student's first year of college. Well, at this school, in the second year, they increased the amount of loans that they awarded. So the net price is about $58,000 in year 2, $59,000 in year 3, and $60,000 in year 4, meaning that the total 4-year net price is about $233,000 at this particular college. So remember, this is a generous college, it meets full need, and this example doesn't include inflation. So my advice when you're thinking about whether need-based aid is going to make college affordable is to take that EFC, multiply it by 4, and then add about $40,000 to that. If that number is not going to be affordable, then need-based aid may not be the answer to how you're going to be able to find an affordable college that you can pay for. If need-based aid isn't going to make it affordable, then maybe merit-based aid will. And so that's what I want to talk about next. Now, to talk about merit aid, you really need to think a little bit about the business of college, because college, at its bottom line, is a business. So when students and parents think about college, they tend to think about the acceptance rate. That's the percent of students who apply to a given college and are offered admission to that college. So at Harvard, it's about 5%. At Northeastern and BU, it's about 20%. At Ohio Wesleyan and Susquehanna colleges, it's about 70%. Well, colleges, of course, do pay attention to the admission rate, but they also focus on another number, which is called the yield rate. And the yield rate is the percent of students who were admitted to that college who ultimately end up enrolling at that college in the fall. So at Harvard, 4 out of 5 students, 82% of the students who are admitted to Harvard end up going to Harvard. At BU and Northeastern, it's around 25%, and at Ohio Wesleyan and Susquehanna, it's about 15%. Now, when that yield rate gets into the 20% range and lower, or into the 20s and lower, colleges really start worrying about whether they're going to have enough students who are going to come to that college in the fall in order to generate the tuition revenue that they need to pay their bills. So what do? They discount their prices with financial aid in order to compete for yield with other colleges and attract students to their college. So this third column that I'm showing is the percent of students at a given college who receive college-funded gift aid from the college. Now, it could be need-based aid or it could be merit-based aid, but this is the percent of students who receive college-funded gift aid. So at Harvard, it's about 55%. At Wesleyan in Connecticut, it's 41%. At Northeastern, 72%. And Ohio Wesleyan and Susquehanna, it's almost 100% of students who go there receive college-funded gift aid. So here's the takeaway from this slide. If a college's admittance rate is relatively high, and the yield rate is relatively low, and the percent of students receiving college-funded gift aid is relatively high, that is a college that is likely to use merit aid in its awarding strategy. So if need-based aid may not be the answer to how you're going to pay for college, merit-based aid may be another way to think about it. So we said that merit aid is typically called scholarships, and the factors that often go into it are things like GPA, class rank, test scores, recommendations. Merit aid is most prevalent at private colleges, but more and more public colleges are using merit aid now too. And an important point to remember is that the highest awards go to the strongest students compared to the other applicants at that college. So what that means is that the student may be receiving their highest merit award offers at colleges they might be considering their safety schools. So in other words, a safety school for admission may be a safety school for financial aid too. And as with need-based aid, the way colleges award their financial aid varies. Some colleges use very little or no merit aid. Other colleges award a significant amount of merit aid. And one other thing to just be aware of is that merit awards are typically better for incoming first-time students than they are for transfers. So when you're applying as a high school student, that's when you're most likely to get the best merit awards. So I want to show you some specific merit aid examples. And I'm going to show you Gettysburg in Pennsylvania, and then a couple of Florida colleges, University of Tampa and Eckerd. And you can see their admit rates, their yield rates, and their starting costs at the top. And then in red at the bottom, the percent of students receiving college-funded gift aid. Now, when you look at what their actual awards are, Gettysburg offers a $26,000 merit scholarship to students who get a 1450 on their combined SATs out of 1,600 and a 3.8 GPA. University of Tampa offers $15,000 to students who get a 1380 on the SAT, and Eckerd offers $21,000 to students who get a 1310 on their SAT, 1310 or better. And then they've got some lower awards that correspond to some lower test score ranges. Well, watch what happens when I layer in the 75th, 25th percentile. Now, the 75th percentile means that 25% of the students at Gettysburg scored higher than 1420 on their SATs. And that highest merit award at Gettysburg starts at 1450, a little bit above that 75th percentile. And you can see that that same pattern holds true for University of Tampa and Eckerd. Similarly, those lower merit awards are keyed very closely to the 25th percentile. That's the score that 25% of the students scored lower than at that given college. So it turns out that you can actually make a generalization from this pattern. And here it is. If a college uses merit aid, the best chances for the highest awards are when the student is above the college's 75th percentile. If the college uses merit aid, the awards may phase out when you get closer to the college's 25th percentile. But at colleges that compete aggressively for students, they may offer merit awards to nearly everyone there. So, how do you identify which colleges might award merit aid for different students? This is a website called College Navigator that is maintained by the federal government. And this is where I get that percent of students who are receiving institutional gift aid. So at Gettysburg, it's 82%. At Washington College in Maryland, it's about 96%. And the rule of thumb here, the takeaway, is that if that percent of students receiving college-funded gift aid is over 60 or 65%, it's pretty likely that the college uses merit awards as part of their financial aid awarding approach. If that percentage receiving college-funded aid is over 80%, it's highly likely that the college uses merit aid. So, how can you identify some specific colleges where you might get merit aid? And what I want to show you is an example of a student who's got an 1150 on their SAT. Need-based aid may not be the answer, so they want to identify some colleges where they might get merit aid. Well, U.S. News and World Report publishes that 75th and 25th percentile. And you can see here that at Shenandoah University in Virginia, the 75th percentile SAT score is 1123. That student with an 1150 SAT is going to be above that percentile and could be a candidate for one of the larger awards there. And similarly, at Suffolk and Boston, Old Dominion, UMass Dartmouth, that student is above the 75th percentile and may be eligible for some of their merit money. Now, even if you're not above the 75th percentile, if you're close, if you're kind of in the top half, those are other places where you might get merit awards, including at University of Maine or Pace in New York City or Lesley in Cambridge. So this is a way that you can identify some specific colleges that might be candidates to award your student merit aid if you think that that might be something that would make it affordable. So I want to show you a summary of how colleges award need and merit-based aid. And I've broken them down into 4 categories, and I call them the elite and near elite. Those are colleges that you've certainly heard of: Stanford, Harvard, Amherst, Bates. And the other 2 categories are mid-market or other. And those are colleges that may not be as well known, but could be places that your student might get a good education. And it turns out that at those elite and near elite colleges, their aid policies are to meet pretty much full financial need and meet most of that, nearly all of it, with gift aid. Those elite and near elite colleges use very little or no merit aid. On the other hand, the mid-market or other colleges tend to gap. That means that they don't meet full financial need. There's a gap between the amount of need the student has and the amount of aid that the college awards. But those colleges often use a significant amount of merit aid in their awarding. Now, it turns out that there are probably about 80 or 100 colleges in that elite or near elite category, but there are about 2,000 in the mid-market or other category. So this is how you identify need and merit profiles for your student, and then colleges that might be candidates to meet need or merit. How do you find your true cost? Well, one way to do it is to look at what are called net price calculators. And net price calculators are required by law. Every college is required to have one, and they are required to show the starting cost, that sticker price or cost of attendance, and an estimate of the amount of gift aid the student might receive, and then do the arithmetic to show the net price. Now, here's something to keep in mind. Even though colleges are required to have a net price calculator, they are not required to have a good one. Here's how you can tell if a net price calculator is good. If it asks 4 or 5 questions, it's super easy to use, you can finish it in 10 or 15 seconds, it stinks. If it asks a lot of questions, you kind of tear your hair out, it's a pain in the neck to use, it's probably asking for enough information to give you a pretty good idea of what type of financial aid you might expect. Now, don't get discouraged if the calculators seem to ask a lot of questions, because as you do them over and over, you find that they get a lot easier to use. So you should use them and try them and hopefully find them helpful for you. Another thing that net price calculators sometimes do is it's not quite as easy as it might be in order to drill down to get to that net price, especially if you're not a numbers person. So if you can look at this, there are a lot of numbers on there. It might not seem that user-friendly. All you need to do is remember that key fact Net price is cost of attendance minus gift aid. Remember what the cost of attendance components are. They are tuition and fees, room and board, books and supplies, transportation and other miscellaneous expenses. You subtract from that the amount of gift aid, and the result is the net price. So even if the net price calculator display seems a little intimidating, just be sure to pay attention to those key elements, and you should be able to find it helpful for you. Now, once you do a number of net price calculators, you can compare college costs side by side. And here's where I generally try to pause and take a minute to remind people that we've been talking about dollars and cents and the money part of college. Why? And that's obviously important. But there's more to it than that. You want to make sure that the college is going to be a good fit for your student. It's going to offer the majors that they want and that they'll have a good experience there. So I'm not advocating that you try to find the cheapest possible college, but what I do think that you should do is make sure that you're confident that the college that your student goes to is one that you can afford. And we'll talk about how to make that decision in just a minute or two. So anyway, when you're comparing side by side, I want to show you an example of the net prices at different colleges. And for this example, I'm going to show you a student with an EFC of 15,000, B minus to B grades, and an 1100 SAT. And it turns out when you do these net price calculators and compare the costs, this student's net price at Roger Williams in Rhode Island is about 41,000. At Shenandoah in Virginia, it's 35,000. Wheaton in Massachusetts is 29. Orono is 24. Bowdoin is 18. And USM, living at home and commuting, is about 13,000. So Bowdoin looks pretty good. This is a 15,000 EFC. The cost is 18,000. That's only about $3,000 more. Problem is that a B minus student probably isn't going to get into Bowdoin. So you also want to kind of keep that in mind as you're comparing costs. The other thing I want to point out is that I know that living at home and commuting to USM is not an apples to apples comparison with going away to college and living in the dorm. But the reason that I put that example on here is to remind people that there's always an affordable path to college for everyone. It may not be the path that you have expected, but there is an affordable path for everyone. So the idea of a college education should be attainable for everyone. All right, so we've talked about need-based aid, we've talked about merit aid, we've talked about how to identify your individual net price. We're almost done with the presentation. I want to spend just a few minutes talking about how to plan to pay the net price. So one thing that people often tell me when they're talking about this is they say, okay, that's great. Well, now that I see the net price, I'm going to get some scholarships and pay for college that way. The problem is that the vast majority of scholarships, the vast majority of gift aid, and I'm going to say 90 to 95%, comes from the colleges themselves in the form of these need-based grants or merit-based scholarships. So definitely, apply for those scholarships if you want to. But in my experience, they rarely amount to more than $500 or $1,000 or $2,000. That's, good. That's real money, and it's better to have it in your pocket. But it probably is not going to be the answer when you're talking about colleges with starting costs of $40,000, $50,000, $60,000, $70,000. The way you're going to pay the net price is from income that you earn over time. And what I mean by that is income that you've earned in the past and saved, income that you earn during the college years and use to pay for college expenses, and money that you earn in the future and use to repay loans. So I want to show you a specific example and think through how to decide if the net price is affordable. And I'm going to go back to that award letter that we looked at the beginning of the evening. We said that the first year net price at that college was about $35,000. We've got to remember that the cost of a degree is going to be over 4 years. So there are a couple of important questions that we need to ask. One of them is, how much are costs going to increase? And the other is the aid automatically renewable and on what terms? This is a really important point when you're thinking about college. So in most cases, aid is renewable, but there are a handful of colleges that will offer more aid to an incoming first-year student than they will to returning students. So you definitely want to know what the terms are for renewing aid. And generally, renewing merit aid requires maintaining a minimum GPA in college. Renewing need-based aid requires filing the FAFSA and profile, and then having your income and assets stay fairly consistent over time. So for this example, we're going to assume that costs increase 2% per year, the aid is renewable and constant for 4 years, and we're going to assume that the student has $2,000 in savings and the parents have $25,000 in savings. And this is savings that are available to pay for college. So let's take a look and see how we're going to pay for a 4-year degree at this college. Well, at 2% inflation, that $35,000 in the first year turns out to be $145,000 for a 4-year degree. And the first place I'm going to look is for the student. What can the student pay for his or her own college expenses? Well, this student got a work-study award of $1,800 a year, and this student can take out federal student loans. Now, federal student loans are always the first place to look for loans if you're going to borrow for college, but they are limited in how much you can borrow. They're limited to $5,500 in year 1, $65 in year 2, and then $75 each in years 3 and 4. So you can use some self-help to help pay for the net price. Then we're going to look at the student savings. We said that the student has $2,000 in savings. We're going to use that first because, as we saw earlier, student savings costs or student assets count more heavily in the financial aid formulas than parent assets. So if we use those student assets first, maybe there's a possibility that they might qualify for a little bit more need-based aid in subsequent years. The next place we're going to look is for a student having the summer job. So I always assume that a student can get a job in the summer. If the student gets a job that pays $10 an hour for 40 hours a week for 10 weeks in the summer, they'll earn $4,000. They'll pay taxes, they'll go to Old Orchard a couple of times, but they should still be able to save $2,000 for college expenses. So this is what the student can contribute for college. Now we've got to turn and look at what the parents can do to help pay for college. So these parents are going to look at their budget and they're going to decide that they can use $375 a month out of their ongoing earnings and use that to pay for college during the 4 years of college. So $375 times 12 is $4,500 per year. Then we said that the parents have savings too, and if they use $19,000 of that, they're going to fully pay for the first year of college. So that's a good start. But we still got to finish years 2, 3, and 4. Well, in year 2, we're going to use the remainder of that $25,000 in parent savings. After this, we've used up the resources, the prior income and current income that the students and the parents had. Now we've got to look at additional loans. Now, some people might say, well, this is the student going to college, so these loans will be student loans and the student's responsibility. But the reality is that the student doesn't have a job, doesn't have collateral, doesn't have a credit history, so any lender is going to look at a cosigner for any loan that a student might take out. That's usually going to be a parent. So I always consider borrowing beyond the federal student loans to be a parent responsibility. So these parents will need to borrow $15,000 in year 2, $21,000 in year 3, and $22,000 in year 4 in order to fully pay for college. Well, the good news is that we fully paid for college using prior income, current income, and future income. We ended up with $27,000 in student debt and $58,000 in parent debt. We still don't know if this is a good idea or not. And there are a couple of questions that we need to ask in order to answer that. The first one is, how much will federal student loans cost? Well, during this current year, student loans have been about 4.5% and parent loans were 7%. They're actually going to go down this coming year because of the economic crisis, but I think that using a more normal 4.5% and 7% is more realistic in putting together a college budget. And education loans are generally repaid over 10 years beginning after the student graduates from college. So for every $1,000 of student debt, it turns out that that student is going to have to pay back $125 per year for 10 years to pay off the debt. For every $1,000 of parent debt, the parents will have to pay $140 per year for 10 years to pay it off. Well, we said that the student has $27,000 in debt. 27 times 125 is about $3,363 per year for 10 years to pay off those federal student loans. For the parents, 58 times 140 is about $8,100 a year that the parents will need to pay for 10 years to pay off the $58,000 in parent loans. So that tells us how much the loans will cost. It still doesn't tell us if it's a good idea or not. So how do you decide if it's a good idea? Well, my rule of thumb is that payments for education debt should not exceed about 10% of gross income. So let's look at the students first. The student borrows $27,000. That means that the student needs to pay back about $3,400 per year. And if the student gets a job that pays $34,000 per year, then the amount the student is paying back in principal and interest will not exceed 10% of their income. The good news is that a new college graduate on average earns about $40,000 a year. So in my opinion, borrowing the $27,000 in federal student loans is not a bad investment in that student's future. Because college will pay off in better earnings, lower unemployment, and so on. For the parents, it's a more complicated story because they've got to consider their other obligations, retirement, college for other children. And in this example, I see a big red flag. So when we were looking at how the parents were going to pay, we said that they could afford $375 a month, $4,500 a year out of their income to pay for college. Well, if that's what they think they can pay during the college years, what makes them think they can all of a sudden bump up from $4,500 to $8,100 a year after college? So I don't think that's a good plan. That this college to me does not look like an affordable choice for this family given the resources that they have. Now, when it comes to your own planning for college, the way I suggest you do it is you look at those total 4-year costs and then define what I call your zone of affordability. What that means is to look at those 4-year costs and choose a price point that you feel that you can afford, and any cost below that represents a cost that's within your zone of affordability. Now, some people don't necessarily know what that cost is. So when I'm working with families, and what I suggest to you is to identify the 4-year cost of a degree that requires no parent debt. To me, that's kind of the default starting place for a zone of affordability. Maybe you might decide that you're willing to pay a little bit of parent debt in order to pay for the college that you decide is the right college. But if you know what that parent debt free point is, then you can work from there and maybe hopefully find some colleges that won't require parent debt. And then these are the kind of factors that go into those affordability decisions. Savings, the amount that you can pay during college, debt after college, other children, retirement, and so on. So when I do these presentations, a lot of people ask, well, okay, that sounds good, but how does everyone else do it? And the way they do it is exactly the way we've been talking about tonight. There are generally 6 sources of income that can be used for college. Prior income from the students and the parents, current income from the students and the parents, and future income from the students and the parents. And it turns out that students on their own can pay for a degree that costs $43,000 without any help from parents or anyone else. How do I get to that? Well, I typically think that a student can get a work-study job that pays $2,000 each academic year. 2,000 times 4 years of college is 8,000. I also think the student can earn 2,000 each summer before college. 2,000 during 4 summers before each college year is another 8,000. And then finally, the $27,000 in federal student loans that we decided is probably an affordable amount of debt for students to take. So when you add those up, those come to $43,000. If you are wanting to pay for more than $43,000, if that $43,000 that the student can come up with isn't enough, then you must have a combination of either finding a college with a lower net price, that means a lower starting cost or more gift aid, or you need more resources in the form of either more savings, more income, or more parent debt. That's how everyone pays for college. So we're almost done, just a couple of more comments. One thing that I think is helpful for people is to keep things in perspective. And I often liken this part of the college process to the stages of grief. And for this reason, it's really important to start having some conversations with your student relatively early in the college process. There's nothing worse than your student being admitted to a lot of great colleges and coming to you senior year and saying, hey, here are the colleges that I have been admitted to, and then you have to say, well, I'm sorry, but we can't afford that. So it's always better if the student needs to, if there needs to be budgetary limitations, that the student is aware of them. And when you think about your own careers, I'm pretty confident that you're going to realize that where people have gone to college was not really that important in terms of how they did in jobs or at places that you've worked. What employers really care about is not so much where someone went to college, but what they're going to do for them. So the brand name of the college really doesn't matter very much in the long run. Another way to keep it in perspective is to think about some pretty successful people who went to some colleges that aren't necessarily big brand name colleges. So the guy who founded Starbucks went to Northern Michigan University. The longtime CEO of Walt Disney Company went to Ithaca College. And the CEO of Hershey Foods went to Shippensburg College in Pennsylvania. And then the final thing in terms of perspective is to realize that it's not necessarily going to pay off in terms of dollars and cents. So Colby, American University, and Clark all have mid-career earnings potential that's very, very comparable. The difference is about $1,900, but the average difference in net price is about $58,000. So just because you're paying for a brand name college doesn't necessarily mean that it's going to pay off in terms of earnings. So if you're looking for finding some financial safeties, how can you do it? Well, one way is to go through the process that we've talked about this evening. Identify your student's profile. Identify colleges whose awarding approach matches that profile, and then use those numbers to identify specific schools. Another approach that you can take is to seed your list with colleges that have different awarding approaches. So for example, every student from Maine should be applying to one of the UMaine campuses. Maybe the student applies to an out-of-state public flagship. Maybe to an out-of-state secondary public, like Keene State in New Hampshire, or Salem State, or Worcester State in Massachusetts. If the student has high financial need, a highly selective private college may be a candidate to meet that need. If, on the other hand, it looks likely that merit aid might be the way to make college affordable, there's a group of colleges that called the Colleges That Change Lives, and they tend to use quite a bit of merit aid in their awarding. And then, as I said, a commuter school is always affordable. It may not be the approach or the school that you've dreamed of, but it's much better to get that degree and not be saddled with excessive debt on the part of the students and the parents after college. So that's about the end of the formal presentation. I've got a website and I've got some resources available on it if you want to learn more or check out different links. And then also, as I mentioned, I'll be happy to email a copy of the slides to anyone. My email address is here. I'm going to leave it up on the screen. And so feel free to email me. I'll send it out within the next couple of days. So that's the end of the formal presentation. Thanks very much for listening tonight and joining.